Well, greetings everybody and welcome to the 10th annual Roundtable Awards here at the Investing Roundtable. My name is Mark Robertson. We've been doing this for about 10 years. I'm joined here by my dear friends Ken Kavula and Cy Lynch. Say hello, guys.
Hello, guys.
You know,
Oh, gee.
be careful not to trip over the ropes, and with all those flash bulbs going off, it's really kind of a tough evening out here in the cyber Hollywood, but we've been doing this for 10 years, and this is generally a session where we have quite a bit of fun. Once again, as you're about to see, Hugh McManus has kind of wrecked the place when it comes to the individual awards, and we'll take care of that. But this really is kind of a celebration. We are coming up on our 10th anniversary. This is the 10th actual award show, one every year in February, modeled after the Oscars. And we've had a pretty good run here over these 10 years, and we'll take a look at that. But let's go ahead and get underway, and we'll just take it away. We are a little bit tight for time. Again, it's our 10th annual. This program is all about a group of friends coming together and sharing investable stock study ideas. You see all the names there on the screen. I did include the South Korean Bong Joon-ho, because for those of you who did watch the Oscars, he was on stage all night as the director of So I figured he just might show up on our stage here tonight, so I included him. Didn't get any commitments, but you never know. He's been celebrating ever since the Oscars were handed out. But you basically see a group of people there that have been investing for a while. I know Ann Manning is here tonight. I think Kim is going to join us. Pretty sure Nick Strategos is in the audience too. He's on the lower right. But what it really is all about is this community of coming together and picking some stocks and having some fun, showing people that you can do this, and it is possible to discover excellent companies and load up on them when they're on sale. So that's what this really is all about. So welcome, everybody. We'll get the legal paperwork out of the way first. We are going to talk about real stocks in real time. No investment recommendation is intended. This is all about education. It's for illustration and demonstration only. We are basically going to take a few stocks and demonstrate the analysis. We're going to talk about the results that we've had over the last 10 years. But again, everything is intended to be information to support your own homework efforts. So please honor that. Any views that we make are our own opinions or our own judgments and interpretations. And every once in a while, we will own a company that we discuss. Tonight is the night of Ardelyx. It's the year of Ardelyx for many of us, and many of us do own stocks in that speculative investment, shares that it's speculative investment. For reminders, if you've got friends or family members that you would like to make aware of this public webcast, we do this for free, at least for now. It is for free. You can write to nkabula1@comcast.net, and Natalie will remind you gently. Just 1 or 2 emails per month to remind educational event opportunities. We do a Q&A at the end, but if you're bashful and you have follow-up questions, you can send them to markr@manifestinvesting.com, and we will send copies of slides on request also.
Natalie reminded me this morning, Mark, that she's approaching 1,300 on our list now of people that ask for a notification about the roundtable.
Oh, kept catching them. We've actually caught the eye of some rhinos out there that are paying attention also. We'll probably be talking about that more in the future, perhaps even as early as next month. All right, here's our standing agenda. We basically welcome everyone, especially if you're a newcomer. We do keep it very formal. As Ken was saying, we do keep microphones open. If you've got that type of audio equipment, you can access us through the questions box. And we do make an effort to try to wrap things up and leave some time for questions. I'm going to talk tonight for just a few minutes about our roundtable super investors and just answer that question, who are these people? We'll talk a little bit about our performance. We really don't have any challenges tonight. And we'll spend more time talking about portfolio management concepts next month. Then you see the 4 stocks to be gone over. Norwegian Cruise Lines, Charles Schwab, Gilead Sciences, and what used to be On Assignment, ASGN. We do a poll after we present the stocks, and we we'll open it up for Q&A afterwards. Interspersed into tonight's programs will be a number of awards. I think there's 7 Golden Knights that are handed out over the course of the evening. And on the right-hand side, for those of you that are not familiar with Michigan and some of the other cities like Pittsburgh and Chicago, today is a serious holiday. It's also a very serious holiday down in New Orleans, I know. Those are punchkis. Did I get that right, Ken?
Punchkis.
Punchkis on the right-hand side. They're about 1,500 calories each. And the person in Michigan probably consumed 2 or 3 of those this morning. So many of us are bouncing off the walls or in need of the gym. But
our local weather lady today, Mark, indicated they also had 130 grams of fat in each one of them.
Oh yeah, I mean there is nothing. You know, it's one of those things. If you have to ask about how many calories, you don't want to be involved with these things. And but they are delicious and they are consumed. All right, let's go ahead and press on. First, I wanted to just take a quick stop. We do this type of thing every few years or so and talk about some of the individuals that are involved with the roundtable sessions. And what you're looking at here is, again, just some reinforcement that these just aren't average investors. They are super investors. What you're looking at across the x-axis is the number of years that these individuals or groups of individuals, mostly investment clubs, have been participating in our Groundhog Stock Selection Challenge at Manifest Investing. We actually have 13 years under our belts, and there's a few people out there. Anything going up basically the scale up to the north on the y-axis is the amount of market outperformance per year. So again, across the axis, it's the amount of time actually being involved. Going up, it's how much you beat the market. So in the case of that wonderful group of ladies from St. Louis, which we hope to see here pretty soon, the Broad Assets, they are way up here at the top of the chart. They've actually won the contest 3 times in the group category. I would love to get some of them involved with a roundtable at some point in the future, but they are knocking it out of the park. Our friend Hugh McManus is just, well, he's special. He has his own collection of core investments that he's brought to the roundtable, like Costco, almost 10 years ago now. Other companies like that, but then every once in a while he sprinkles in an Ardelyx or a Bank of America when everybody's holding their nose about banks, and that's how he achieves a rate of return that is basically about 24%. That's per year, folks, for 10 years, and how he gets up to the top of that chart. But you see Nick Strategos' club here, Kim Butcher, one of our damsels down there, and just this whole cluster. Keep in mind, these are people that are beating the market. So there's quite a few under that 0 point. And keep in mind that the majority of professional rhinos are actually under that line. So there's a bunch of stuff here. Susan Michelik out of Wisconsin, Ann Manning out of Houston. She won one of the original groundhog contests years ago. She continues to pick stocks. She and Cy are both, they like stocks that are not dramatic. And look, they both end up here at 11 years and beating the market by a couple percentage points. And Ken and Nick and myself were all out there. And last but not least, Herb Lemkool has a number of investment clubs he's involved with up in the northwestern part of Michigan's Lower Peninsula near Traverse City. And again, so these people demonstrate not only in the groundhog, but in other areas where we pay attention, including model clubs for the better investing audience. They basically demonstrate this prowess, and I just say my hat's tipped to all of you. Any questions on that, Ken, or any observations, Ken or Cy?
No, it's just nice to see so many folks above the market zero there, Mark.
Isn't there just cranking away? And I will notice that we track hundreds, if not thousands, of professional investors in mutual funds. There's only 2 on this list. The two are Eddie Elfenbein out of CrossingWallStreet.com and the Brown Small Company, which you've heard us all talk about a great deal. Those are the only 2 institutional entries in here that have actually hung with this crowd for the last several years. And there's a couple more that'll be coming, but lots of good, clean fun. All right, well, back to what this is all about. It is about sharing. It's sharing of an idea. We do this generally the last Tuesday evening of the month. We do try to pick stocks that will collectively outperform the total stock market as measured by the Wilshire 5000 by 5 percentage points. We'll talk about how well we've done here in a minute. And our accuracy guideline is we just like to pick stocks that go up more than the market half the time, hopefully about 60%. Here's a look at the track record for the round table. We've taken a bit of a hit in the last couple of days. Our rate of return, that's an annualized rate of return since July 2010 of 17.3%. Again, that's annualized. And if you had taken the same amount of money and matching investments into the Wilshire 5000 mutual fund, that has a return of 11.8% over the same time when those investments were made. 17.3 minus 11.8 means that the roundtable collectively, our collective performance, outperforms by 5.5 percentage points, as you see here in the math. And 5.5 percentage points is actually pretty outstanding. The outperformance accuracy checks in at about 50%, so we're a little bit shy of where we would like to be, but not bad, especially with a relative return of 5.5. So that 5.5 actually corresponds to the farthest right point on the performance graph. So we are hanging out in above the objective. We teach, or it's our interpretation that the modern investment club movement has the objective of beating the market by 5 percentage points. So over the very long term, that's going to be beating a market running at 10% and achieving a 15% return. And those that can achieve that, and we know many people who do, some that do better, it's quite an exciting thing to get, especially when you start getting a few years under your belt. Any comments or questions? Or are we just happy?
I think we're just happy. Michael Haney just wrote a question. Can you explain the outperformance accuracy? I think you've done an admirable job. Michael, if you still have a question on outperformance, why don't you drop me that question again and we'll try to say it to you in different words.
Okay, we'll press on and we can come back to that if we need to towards the end. Again, as I mentioned a few minutes ago, it has been the year of Ardelyx. If you're not familiar with the stock, it is a Hugh McManus special situation that he has brought to us a number of times. The ticker symbol is ARDX, and this is one that he first brought to us a couple of years ago. It's a company working on some very fascinating and promising solutions for irritable bowel syndrome and for stage 5 renal treatments for controlling, is it phosphorus or potassium, Ken?
Phosphorus.
It's phosphorus in the blood levels.
No, potassium in the kidneys. Yeah.
So potassium levels in a renal stage 5 patient, that's doing the dialysis and everything, they have a couple of medications that are really promising. And Hugh basically has taught us how to watch a company like this. I'm pretty sure they don't even have earnings yet. This is not a company that plays well on a traditional stock selection guide, but it's a situation where if these guys actually get their act together and deliver on those solutions, it can get pretty exciting. It's kind of neat that back in the late 2018, you may remember right around Christmas Day 2018, we added to Ardelyx at that point. We added right around here. Hugh came back and added a few more shares in here over the last year. So he's been accumulating all these shares at between $2 and $3. And it recently just about reached $9 a share up here. Actually got at $8.81, and it actually has relaxed back to $6.99 at tonight's close. But that's a pretty spectacular return for the portfolio. And that leads us into our first golden night. And the number one stock selection for their last calendar year is Hugh McManus with his selection of Ardelyx. And I think you can see how special those returns have been since July and February and August of 2019. These are stratospheric numbers. doing very well. I mean, I was pretty happy with Regeneron. In many years, that would have been a contender for the top finisher in this award. You see, he snuck in there again with Ardelyx again, and the biospecific step. There seems to be quite a theme running through there. Wouldn't you guys agree? Along with last month's selection of Gilead.
Yes.
It's not, and Cy sneaks in there with a couple of situations that are pretty interesting too.
Well, I'll tell you one lesson that I've learned, Mark, and that's to listen to Hugh very, very carefully, and then the next day buy a little tiny bit of whatever he's suggesting. It seems to, for the last 4 or 5 years, it seems to have really worked for my portfolio, probably adding a point and a half to my portfolio. So as long as he's doing well, I'm gonna ride him as far as he'll let me ride.
Yeah, I would second that. I mean, he's not infallible. His selection of staples, although he ultimately was right, his selection of staples, he believed that somebody was going to come in and take the company private, and he was right about that actually taking place, but wrong about the price. And that one actually was a downer, but he's often right on these type of things.
Mark, we have a hand in the air. Michael Haney has his hand in the air. I'm going to unmute him and let him ask his question, okay?
Absolutely.
Michael, go on. We're evidently having some microphone problems. I'll give it a try again in just a second. Yep.
Okay, we can try again.
Okay, why don't you continue, Mark? Yeah.
All right, so you can say over the. Go ahead.
But before you go on, Mark, I was just going to say, and this has to do with the outperformance accuracy as well. You can have a significant number of mistakes, if you want to call staples a mistake, when you have returns like Ardelyx sitting there.
Oh yeah.
Because again, as I love saying, you only can lose everything, but your upside is infinite. And this is an example. I mean, he didn't lose everything in staples, but if you had 100% loss in staples versus, and that's a relative return, 100% plus, you'd in a two-stock portfolio, you'd still be up very significantly.
That is such an important thing to latch onto, and thanks for bringing it up, Si. I mean, it's kind of like when your child brings home the report card and there's 4 A's and a C, and you focus in on the C. Parents have been doing that for forever, right? Since the beginning of report cards, when you really should be focusing on what goes right with the 4 A's, and then kind of back into the C, right? And so we as investors spend 9 times as much emotional energy on a loss of 10% as we do to appreciate a gain of 10%. So we all are hardwired to have this aversion to red ink and negative numbers. And one of my favorite examples, just like you said, Si, is David Gardner talks about how his 1 or 2 picks for his rule breakers portfolio actually outweigh like 100 losers. It's just like it's just amazing how we focus in on the wrong thing, and we should celebrate the success. And as you can see, a number of different type of companies on the list, and a number of different contributors have actually brought home this golden night. Let's go and do the all-time best selection because
Mark,
yes.
We're back with Michael again, and he's been trying real hard, so I'm going to try to unmute him this time and see if we can get his question, okay?
Absolutely.
Michael, go on.
Oh, sorry. I think I raised my hand inadvertently. I apologize.
Okay, no problem. I'll take it down, and we'll continue then. Thank you.
Okay.
Go on, Mark.
Let's go ahead and give out the second golden statue for the best selection of all time. And again, the Ardelyx for this year is kind of dominating. It'll be interesting to see if they can hang up there and as this thing rides out. As many of you know, many of you have in the audience have been following this Ardelyx situation. Hugh shared that he's actually watching it fairly closely too, and if it kind of gets stuck at a plateau in the $10 to $12 range, he's probably going to take some profits. That's code for sell some of his shares. It's just something to be mindful of, and he's been keeping us abreast. By the way, if you do follow the company at all, they do have a presentation that they're making tomorrow at a dog and pony show that you can get to at ardelyx.com. If you go to the investor relations section, they're making a presentation at a health conference tomorrow. So in this case, Ardelyx again dominates this. You see some of our scorekeeping here. The yellow shaded in stocks are stocks that have actually been closed out or sold from the portfolio. Those are highlighted on the chart, so those are locked in. The other ones that are still not the unhighlighted line items on this page are moving around daily. You can see that those have been pretty substantial. With Amazon, 2015. All right, so here are some of the stocks that are in the portfolio itself that have contributed to that 5.5% market outperformance. You're looking at the top 20 holdings of the portfolio. You can actually access this portfolio to see all 80 or 85 current holdings in the portfolio at that link at the top. The legend up at the top is the number of repeat selections every time one of us or a damsel or the audience votes for a stock we invest $1,000 into. So in the case of Microsoft has had, where's it at on the top up here? Okay, Microsoft has been invested 5 times, so it's got $5,000 invested. The $5,000 invested is now worth $37,576. You can use that to break down the code. Isn't that impressive, guys? Pretty wild. Cognizant is the most frequent selection at 15 times. Even that has almost doubled at 24,000 in the portfolio. But keep in mind, these are the 20 largest positions. And you see our friend Ardelyx right there. And even though it's down fairly dramatically, over 20% in the last couple of days, this is last night's close or yesterday's close, still hanging in there pretty well. Any observations, Ken?
Well, I just love to watch this whole thing. This entire portfolio can be found at Manifest Investing under portfolios off to the right side. There's the round table is listed. You can get the entire worksheet for the round table, but these top holdings have a lot of very familiar names to them, but I think it would do a lot of you, it's a great exercise to take 3 or 4 of the unfamiliar names and look at what good solid stocks they really are. We have some really undiscovered beauties sitting among this top 20 or 25 stocks here.
Yeah, and Ken, maybe we'll take a little bit deeper dive into portfolio management next month, but why don't we spend just a Reader's Digest moment talking about the condition of this portfolio and what you look for, on your, I don't have a report card slide this month, so we'll have to do it from here.
Well, what is par right now today, Mark? What is my par today? About 10%?
9%.
9%? Okay, so Manifest does a number for us every single day. Think of it as doing an SSG on every single stock in the database, getting a par number, a potential annualized return number, and then looking for the middle number, the median in that list. Today, Mark said it's around 9%. George Nicholson said when he put investment club concepts together, said that he thought that a good investment club could beat the market by 5 points. That's what all of this that we're doing, all this mathematical stuff that we're doing is based on. So you add 5 points to the 9 and you get around 14. That's the return that we're aiming for. That average at the very bottom there is a weighted average, that 12.5 in the par column, way down in the bottom right-hand corner. And so we're a little bit lean on the par right now. We'd like to move to 14. So the way you do that is you consider moving stocks with low par out of the portfolio when you keep buying stocks with higher par. That's not rocket science. Our quality we like to keep in the upper quintile. That means that 80 percentile or above for the weighted average on quality. Financial strength and earnings, good target values are in the 75–80% range. Again, weighted averages in this portfolio, even though it's a tracking portfolio and contains many more names of stocks than you would normally have in a club portfolio or in a privately held portfolio, you're still looking for the same general ideas in managing the whole thing. So our numbers for quality, earning stability, and financial strength are all pretty good. Sales is the number that I like to focus on more than anything else, because as a fundamental investor, I really do feel that everything that we look at in a stock flows from sales. Every number can be derived in some way, shape, or form from sales. Nicholson suggested 11.5, 12% would be great sales to have. If you're aiming for that 5 points above average, that's where that 15% number in better investing comes from all the time, by the way. Our sales are right where I'd like them. You know, you might want to nudge them up another 1/10 or another 2/10, but I think they're in really good shape to outperform. And in fact, the portfolio is outperforming. I would love to see the par even a little bit better than 12.5, but I'll take 12.5 any day at a 9% average market. That's a plus 3.5 points, and I know that that's extremely difficult to do over long periods of time. It's a great return. The portfolio has an awful lot going for it, and the purpose of this tracking portfolio is to show the general public that we can actually do what we say we're going to do. We celebrate the top 5 or 6 performers every year, you know, in stock names, but there's a whole slew of good, solid workhorse type of stocks that are keeping this portfolio above the market average and above the +5 that we're aiming for. This is just a really good portfolio to take down, read, study, look at some of the components, and ask a lot of questions about.
Okay. Thanks, Ken. And with that, I think we'll go ahead, and I believe Norwegian has been selected a few times, right? Yep.
I think 2 or 3 times, Mark.
So this will be the 4th selection of Norwegian Cruise Lines. And so you must not have any qualms about being quarantined on a boat somewhere. Go ahead.
Well, I'm considering the fact that there's been a lot of publicity about what's been happening on some of these cruise ships, and they have quarantined some cruise ships, just like they've closed the entire, you know, million-plus city in China and tried to close down an entire province for what's happening right now. But I also do think that this problem, as most problems that we're looking at, will pass at some point. And I think maybe, just maybe, we've overdone it just a little bit. And I'm going to try to make the case for Norwegian Cruise Lines making a pretty decent comeback from where it is right now. Next slide, please, Mark. This is from the Norwegian Cruise Lines end of fiscal year report, and they list 10 things that they're especially proud of. I look at 4 things on that list of 10 because I think that they point to the company's continued push towards growth and continued stewardship in a way that keeps the company lean and mean and doing the kinds of things that investors would like to have it do in order to make money for the shareholders. They're making a strong push into Alaskan cruising. They've gotten some places in Alaska that they are one of the few cruise ships that can move in some of those places. But if you look at their bookings, you'll notice that more and more of their cruise is going to be focused on Alaska. That's a big growth area. They're moving away from some of the areas where either there is too little competition, in other words, nobody's cruising there, or there's too much competition, in other words, all the ships are cruising right there. They're also paying a lot of attention to building new cruise ships, and they have them coming out at about one a year through 2027. They're in a number of different brands. You saw on the title page 4 different brands from what you might consider cruise for the everyman to extremely high-end luxury cruises. They have different brands to meet the different needs. They've taken advantage of the low interest rates that exist out there right now, and they've refinanced a huge part of their debt. If you're building cruise ships, you're going to have some debt, and they've refinanced it at the lowest possible rate that they can get for 10 years. And that speaks to me that they're being very proactive with the borrowing that's going on. And they've done a nice job of returning capital to investors while the shares look to be in a position that you might want to sell them. You know, companies, in my opinion, too often do share buybacks, but they don't pay any attention to when they're doing it. And that means sometimes their SSG is not anywhere near the buy or the sell zone, and yet that's what they're doing. Norwegian has been pretty careful when it's buying back shares and returning that capital to investors. And it's resulted in what I feel is a very strong position for the company. Next slide. They have the highest net ticket yield. They have the highest net onboard yield, and you can see that that onboard spending amounts to more than 50% of the ticket yield. So it's a very important component of the revenues for a cruise ship, and that gives them the highest net yield of any of their competitors. That's a real plus for this company. You notice they're touting the fact that this has been happening for 7 consecutive years of net yield growth as well. Next slide, please. This slide is showing the global ocean cruise passengers. This isn't company specific. This is the total global ocean cruise passengers. You can see them growing at just under 6% compounded annual per year. You can see there was growth during the 9/11 time. There was growth during the Great Recession. There was growth during some major geopolitical events in 2016-17. And it appears that this growth in cruising is just something. It's something that people like to do, want to do, and it appears not to have a lot of resistance to major things going on in the macro economy or in the world itself. Next slide. You can see here where their ships are being deployed, and there's that growth in Alaska from 2019 to 2020. Skip down, if you would, to Asia Pacific, Africa, and you can notice that they're pulling ships away from that area. They will continue to pull ships away from that area. And it's because there's not a whole lot of desire for people to be cruising in that area. The virus probably has just made it all the worse, but that trend was there well before the coronavirus. The same is true about Bermuda and the Caribbean, only the reason is for the opposite thing going on. Everybody is putting ships on cruises to the Bermuda location and to the Caribbean. and Norwegian has decided to cut back a little bit there, increasing in Europe, and overall, I think they have their priorities straight to put their ships where there's some competition, but not enough to make them just one run-of-the-mill ship, and not enough to have them cruise with only partly filled ships. Next slide. They've given a lot of guidance even before the coronavirus really got into the news big time, as it has the last week or so. This guidance is maybe a couple, 3 weeks old. They're indicating there will be an adjustment made because of the coronavirus, but they expect it to be relatively minor, and they expect it to be relatively short term. Next slide. This might be a triple play. George Nicholson outlined triple plays, and he said, in order to have one of these triple plays, which means you have a great chance to make a fair amount of money if these 3 things are in place, he said you should look for a depressed stock price. Well, on a value line sheet, to me, a depressed stock price would be double-digit or more at the low and the high side. Notice that value line is suggesting 16% annualized return at the low side, 29 at the high side. The second category would be the possibility of having PE expansion. So we'd be going from a PE of around 12. And if you follow that arrow down to the data box, you'll notice that value line is suggesting the PE might expand to 16. And the third set of ideas for the triple play is the possibility of net profit increase. And notice on that line that I've boxed in, net profit going from 13 to 14 to 15, back a little bit, then up to 16, but 3 to 5 years going up to almost 19%. That's 18.8 way over there on the right-hand side. So this might very well be a triple play, and these are especially attractive when the market is having some issues. And I think the market is having some issues right about now. Next slide, please. Here's right off the Morningstar page, and this is written February 20th, so it's a relatively new piece. They did have a fairly flat earnings from the last quarter in 2019 to the end of the first quarter in 2020, and almost all of that was attributable to the coronavirus and to the drawing back of some of the cruising that was scheduled but not actually followed through on in order to be absolutely safe with the passengers on those ships. Next slide, please. Here's the visual analysis. You can see that flattening of earnings from 2018 to 2019 that actually was happening in the last quarter of the fiscal 2019. I circled the 2020 price bar. You can see that it's trading at or near a 52-week low, and in fact, it definitely was at a 52-week low. It's down about a little bit more than $3 from where that is. That's yesterday's tick, so it's down another $3 or so when we're looking at it. Next slide. I'm suggesting very modest growth in sales and earnings for the next 3 to 5 years. I figure if I can set a low bar and the company can meet it, think what my return will be if it really beats these very modest goals. So I'm setting 8% for sales growth, 9% for earnings growth. You can compare those to Value Line's numbers. These are under Morningstar numbers. They're under the ACE numbers that exist. I mean, certainly comparable to any of the peers. A good solid return on equity at around 15% for the last couple of years. And the debt levels, which I can explain, again, they're building ships. They're looking to put out a new ship, one a year for the next 5 or 6 years. Next slide. Here's the eagle from Manifest. I circled where the 20 mark is because that's where the par on Manifest is tonight. In fact, it's a touch over 20. And if that red line were to be drawn up to 20, you'd notice that that's a historically high value then over the last year and a half to 2.5 years. I like to see that. I also like to see this very horizontal quality line. If anything, it's trending up just a touch after it took a little bit of a hit back in July 2018. But I see nothing to worry about on the quality line. I like the trend for the par line. That 18.4 is now 20.3 for Manifest. Next slide. Here's the synopsis of my SSG. I used very, very conservative PEs at 15 and 8. I still came out with a 7-to-1 upside downside, somewhere in the neighborhood of a 12 to 18% value. And if I use today's closing price, I actually get a value somewhere between 14 and 20. So I like the fact that it's a good, solid company. It's done a lot of thinking about where it's going to be. It has growth drivers. And most importantly, in my mind, it's trading low enough that it's going to give me a fairly decent return if I'm just patient.
Okay, well, thanks, Ken. All right, let's go ahead and hand out a couple more statues. This has to do with that accuracy, outperformance accuracy that we're talking about. Again, we measure the number of selections made and how many of them beat the market. And every single selection Hugh made last year, he was 6 for 6. Actually beat the market for 2019, so he takes home the annual award for 2019. And here's where Herb sneaks in, thanks to Ionis Pharma and one other company. He's now up to 80% of his selections outperforming. Hugh checks in at about a 76% for his dozens of selections. But Herb managed to edge him out on the all-time highest accuracy. So, Ken, I think we need to get Herb back to add to his spoils here sometime in the near future.
Sounds good, Mark.
All right. Then one quick award that since I can't go home without a statue, I had to go ahead and give Ken and myself an award for the best picture category. Now, I know they normally save this last for the Oscars, but this is kind of our People's Choice Award. We've received a huge amount of correspondence and commentary back from the community on the series we did on the projected return on capital. We actually kind of culminated it with a session a few months ago. You can get access to that on the Manifest Investing website. It's a YouTube archive. If you can't find it and you're out there in the audience and want to check it out, just send me an email. And I did have a couple of honorable mentions. For those of you that don't know it, Ken and Cy and myself and Hugh, our 4 selections that we made last February actually won our stock picking contest at Manifest Investing. So we actually were the group champions for 2019. So we're kind of proud of that. And one extra special, extra mention, honorable mention. Hugh's worked just last month on the FDA pipelines again in Gilead. It gave me chills. It kind of took me back to what he put together right below it there. In 2018, he did some wonderful work talking about how to read the development of pharmaceuticals, promising pharmaceuticals, and Ardelyx. And I'm not so sure that Gilead is not this year's Ardelyx. At least it has the potential. And then there's just a number of other programs going all the way back to Chinese pulled pork back in 2010. So congratulations, Ken. You and I actually stumble out with an award this year.
All right.
All right. So with that, we'll go to the awarding. Cy Lynch. for his
All right.
repeat selection of Schwab.
Yep. Thank you, Mark. And tonight's pick is Schwab, and I will go ahead and say both for time purposes as well as I think relative familiarity. I'm not going to talk a whole lot about the company. We're going to talk primarily about the stock and how I chose it. You can see the historical information quite up straight and parallel. Also, Value Line has started tracking an 18-month target as well as the 3 to 5 year, and then of course the 1 year timeliness issues. And you notice that at actually it was yesterday's close, they were projecting about a 20% potential return over the next year and a half. So Value Line says that there's some near term as well as both by Value Line and, as I will show tonight, some longer term potential here. Next slide. I usually start, I ranked the current portfolio for the roundtable by par and went down and pretty much looked at companies that I feel pretty good about generally and that I tend to track. There's a few that I didn't mark here that I do know something about and even own, but the companies that I wanted to consider, you could see Schwab, EPAM, PayPal, and Google. And by way of disclosure, since I'm going to be talking about all four of them briefly, I believe I own all except PayPal. Next slide. Here's just kind of a quick comparison of the three. I just did a quick dashboard, ranked it by par. You see Schwab is the highest par. And for those of you who have had my portfolio management classes, and it's pretty much the modeled portfolio techniques that are used in manifest portfolio management things such as Tin Cup and the like. When you're looking at options, generally all things roughly equal, you go for the highest par. And as Ken mentioned, I think a priority for our portfolio right now, we need to be looking at boosting par somewhat, because we are, if this were a fully managed portfolio, we would definitely need to be doing some selling and shuffling around to boost that par, because we could be risking our long term. So I decided, even though you could see Schwab isn't necessarily the highest quality, it's second on financial strength, it's excellent all the way through, and it's got a decent growth rate, although it is the slowest of these four companies at 9.5. So I chose to go with Schwab. Next slide. I just did a quick stock search just to see if maybe there is something else out there. I did a 19% par and an 80% quality, 80% financial strength, and 60% EPS stability, which kind of tracks Schwab a little bit on the low side. You do see Skechers came out with a potential higher par, 5 below, right in there. I decided not to go with footwear, and I stuck with the Schwab pick. But that gives you some idea that based on par and quality, Schwab is about the best combination, both in the portfolio to accumulate as well as out in the Solomon database. Next slide. Again, doing a quick industry study. You see Raymond James is higher quality, but again, Schwab at 87 is just fine. TD Ameritrade, as I think most of you know, is being acquired by Schwab, so it's significantly lower par. Plus, again, to the extent that you find TD Ameritrade attractive quality-wise or growth-wise, that's going to be becoming a part of Schwab before too long. Next slide. And here, my judgments and the bottom line on Schwab. I'll say one thing about the company and the business. We, of course, always think of Charles Schwab and other brokerages as companies that buy and sell stocks as agents for shareholders. And that certainly is a large part of their business. As I mentioned, they are acquiring Ameritrade, so they will significantly increase their customer base and sales volume. They're also acquiring a company that I'm somewhat familiar with personally, although I don't believe it's a huge volume addition, but the brokerage and wealth management assets of USAA, Schwab is acquiring as well. So they will be adding, and none of my projections nor value lines and most of the analysts take into account those things. The other big thing, as Ken mentioned in his more recent presentations on Schwab, because he and I've been picking Schwab some over the last 12 to 18 months, he's specifically mentioned that Schwab, in addition to what we always think of, that being the broker, has a significant wealth management aspect. By and large, some advisory services offered by Schwab, although generally they do that through partnerships with private advisors, but they have a significant number of ETFs and mutual funds that are managed by Schwab and that they get fee income off of. So a significant amount of their money is not purely trading based, which is a good thing given the fact that commissions have gone to zero and are venturing there. You see 10% sales growth projection, a 40% pre-tax margin, which I think equated to a net margin of about 32%. If I recall, I could not use the manifest format because I am using the more traditional revenues and profitability measures on my stock selection guide, so I couldn't convert it over easily to the manifest return on equity and book value growth. I did not do that this month, but my projected earnings per share is somewhat conservative compared to the manifest consensus, which is a little over $5 per share, compared with right at $4 that you see. Then those projections using an average PE of 22.5 leads to, at yesterday's close, a 16.5%, again a little below the manifest consensus return. However, at today's price, just to show that Ken didn't pick the only company that dropped some today and added additional potential, the range at today's close runs between 18% average and 26 on the high side.
Awesome.
So again, a little bit of a drop and perhaps a great buying opportunity today. So
Okay.
I'm adding to our Schwab holdings.
Well, thanks, Si. And that's a multiple time selection also for the portfolio, and certainly a company that's, if everything works out with their acquisitions, has a lot of promise. All right, so let's talk about who had the best relative return for last year. And again, no surprise here, when you have 5 positions in Ardelyx, you're going to win this. So I left Hugh's picture off this slide and just put some company artwork on the page. And he would like to note, however, for everybody, that his selection of Gilead 1 month ago, and in fact, if he were here tonight, he would point out that he is picking a company whose price went up when the other 499 stocks went down from the S&P 500. Gilead Sciences, due to potential solutions for the current coronavirus situation. So anyhow, once again, he's returning to an award he won the first 3 years, and we've all taken turns since then while Hugh is back. relative return, best annual performance in the leading role. He did double down on his selection of Gilead last month, and I'll just do the Reader's Digest version. He thinks this company does not get enough credit for the pipeline that it has. It does suggest that they need to go outside the company to find some stuff, but this is a fascinating company that's very non-traditional and very difficult to do a traditional analysis on, because they have the problem of putting themselves out of business when they're successful. Their hepatitis drug is a solution, not just a treatment. It's not an ongoing care situation. So they basically, by being successful, eliminate customers. And that's why it's such an unusual company to look at. If you go back and listen to the webcast from a month ago, he went through and described a number of very promising areas in cancer and coronary and in various different areas where he believes that these guys are going to be doing just fine. And as I said, they are working on that coronavirus thing along with another company that hit the news today. So again, this is not for the faint of heart. It's a typical Hugh McManus, very difficult situation. I'm sure he will have different things to share in future months, but it's kind of the latest one on his screen. One of the things that I do believe he likes to point out is it's been, you can see the success of the hepatitis drug there in the middle of the chart and how much the price advanced from 2012 to 2016. And again, they've basically put themselves out of business with the hepatitis stuff. And the stock price has been relatively flat for multiple years. That can sometimes be reason enough to, especially for a well-managed company that's in a situation like they are, to give them some consideration. And again, he wants to double down on them tonight. Transition to my stock, it's ASGN, that's the ticker. Also, it's formerly on assignment. You see the visual analysis on your screen. That the business model up at the top has certainly been pretty steady. They are an acquisition-driven company. That's why you see the sales ticking up on the left-hand side of that chart. But the last 5 to 7 years have been pretty straight. They are continuing to do smaller acquisitions, but definitely an up straight and parallel situation. Kind of in a fascinating area where these type of companies, including Korn Ferry and a few others, are showing up on our screening results. And since we live here in Michigan in the shadow of Kelly Services, it's something that we do pay attention to every once in a while. Here's a look at the Sweet 16, just a quick look at some of the companies that made the list. I wanted to share this because I want you to see the number of cruise lines. You think this isn't an area of carnage? Carnival's on here too. And these are all companies that basically meet our requirement of high, longer-term return forecasts and decent or excellent quality. So they're at the top of our rankings. And what I wanted to do is go in and look for companies that are trading close to their 52-week lows. And as Ken told you earlier, Norwegian is right there at that 0.4%. So this is anything close to zero means that the company is trading close to its 52-week low. Many of you who have been around here for a while know that Hugh McManus will often shop when companies get within 20% of their 52-week low. Many of these would qualify. I also wanted to add the criteria of the relative strength index. We'll take a look at it on the chart from stock charts. And anytime a company gets down under 30, it's potentially oversold, where the rhinos have basically been running away from it too fast. But anytime it gets down in this realm, around 20 or less, it can really be an opportunity if the company's not going to go terminal on us. And so the ASGN definitely fits that model. Decent long-term return, excellent quality, good projected return on capital. Value Line likes it at 18%. Morningstar says it's on sale at 75. The analyst consensus says 75. And by the way, the average stock now is up to about a 20% return expectation for the next year. So this is still pretty good at 37, but you can see a lot of the companies on this list appear to now be attractive over the next year. So there's some other really good studies on there. Note the presence of Walgreens. Universal Insurance is a decent study, so is MGP Ingredients, but just some pretty decent studies from top to bottom. But I went with ASGN. You can see that they have been absolutely hammered for no particular good reason other than recessionary fears and the supply chain fears, all the stuff that's happening here over the last several days, you can see that they've lost a great deal, and it just may be overdone. You can see that the relative strength index has actually dropped below 20 as of tonight, so that can be a potentially attractive situation. Quick industry study, as I did. In this case, we're looking at the staffing and outsourcing industry. I, much like Cy, will sort them from best quality to worst. So again, many of these companies, from Robert Half on down, all the way down to Ardelyx and Staples, pretty good companies. Some of them fairly compelling return forecasts. So there's some pretty decent studies in this group. Again, if you believe that business, world economies and business conditions will improve and that we're not headed for the hotter climates in a handbasket, some fairly interesting opportunities there. No lower PEs and some fairly decent growth rates there to take a look at. So again, going with ASGN, again, formerly on assignment, current stock price is at 55. It's about a $4 billion company, growing 12%. That's the growth rate through this portion of the chart. And by the way, we do use the Y charts, analyst expectations. Their forecasts for 19, well, 20, 21, and 22, along with the value line estimate out here to come up with that 12% growth forecast. So 12% growth forecast, fairly easy to defend, a projected net margin in the 5 to 6 range, selected analyst consensus range of 6. The PE ratio, again, just eyeballing it, it would be easy to assign it something around 20, which is what Value Line does, with 18 for the PE ratio. So again, we're looking at a company that's in, much like Cyan, upper teens, low 20s for the projected annual return. Capital management considerations, decent return on capital. You can see that their effective interest rate is 5%. Has that relative strength index that is very low, and a decent long-term return forecast from Value Line. So I really like the characteristics. Again, the up, straight, and parallel nature. And these guys really seem to be knocking it out of the park. They do a lot with IT and computer type consulting, but I'm kind of fascinated by the traveling nurses and some of the different type of occupations that they support in contrast to some of their competitors. A really wide berth, which probably helps them when it comes to economic challenges. So they're pretty well represented across a wide berth of industries, and they certainly appear to be managing that staffing and outsourcing opportunity environment pretty well. Go ahead and add ASGN to our tracking portfolio. And with that, Ken, I think we can go ahead and pull away.
The poll is on your screen, folks, and all you have to do is pick one of these here. Use your mouse. We have a nice size audience tonight. About 2/3 of you have voted. We'll give those of you that are a little bit slower just another maybe 8 or 10 seconds here. I'm going to close the poll and reveal the results, and it looks like we're going to add a position for the audience in Charles Schwab. Certainly one of my more favorite stocks and one of Cy's more favorite stocks. So I'm glad to see the position being held. Norwegian Cruise Line's a close second. Gilead and On Assignment pretty well tied. There's a couple or more of you out there that don't like any of them, so that's okay. Let me hide this now, and we'll go back to where we're going to be in the future. Oh, Mark has another award.
It's the last one of the night, so the music hasn't started yet. We've still got a few minutes, and he was back and has recaptured the highest rate of return. So we joke about him having a trophy stand. He thanks to Ardelyx this year, he's back up at the top of this again, and he's running at about a 23% rate of return for his stock selections in the roundtable tracking portfolio, which is really pretty phenomenal when you look at it over time. And he does it somewhat unconventionally every once in a while, but you can see that he's dominated this category. And I just want everybody to know that, when I grow up, I want to win this one year. To catch up, and when I grow up and become an investor someday, it would really be nice to see my name on this list. So that's how I get out of bed in the morning. I want this list. Yeah. And he's really making it tough on us, guys.
Yeah, I know he is.
Kim broke through. Yeah. Kim had it for a while, and she's right there too. And I'm not far off, but he's making it pretty tough on all of us. And of course, it all adds to those numbers that we cherish. And when you're running at 17, 18% over 10 years, it really is pretty special. And I know it's made a difference in a number of portfolios. It's made a difference in mine. I know it made a difference in my parents' portfolios. And it's just something that we do treasure doing, and I really appreciate what you guys do. I just want to thank you for your efforts.
Well, Mark, we can just turn this into a one giant thank fest, because you inside don't realize how much you're appreciated by the general audience and by the folks here in mid-Michigan. We just really think that you guys are something special, and that helping us do this program and allowing us to have the benefit of what you guys know and what you think really adds a lot to the investors in my area, at least.
Well, appreciate that. Thanks.
Thank you,
everybody.
Ken.
And
We're going to be.
Go ahead, Ken.
We're going to be doing a lot of traveling. We're in St. Louis in April, in Philadelphia in April. We're at the National Convention down in Dallas in May, and I'll be traveling by myself down to Columbia, South Carolina in June. In September, Mark and I will be in Northeast Ohio, and tentatively we're going to be in Indianapolis, Indiana. In August, Mark and I are going to be in New Orleans. Can you imagine that? New Orleans in August. So,
I've done that.
Yeah.
I won't even be able to eat oysters, Mark.
Well, we'll find a way to survive. But in all seriousness, we talk about how it is so cool to get out there and spend time with the investors. I mean, just a couple of weeks ago, Ken and I visited a investment club in Lansing, Michigan, and I think we had a better time than them, Ken. But it's so refreshing to see such talented and attentive investors. That club is beating the market. They've been around for what, 10 years, Ken, or something like that?
10, 12 years. And Mark, they called us in to speak for a half an hour, and about 2.5 hours later, we finally had to beg off, reminding them that we had an hour to drive, and they didn't. So
yeah, we do enjoy those opportunities, and those of you that have reached out to us, we're going to find ways to support that as best we can going forward.
Yeah, and I'll be in Atlanta in August as well.
Okay, I'll get those added to the next.
For the Atlanta fair, Atlanta for the Georgia fair, I should say.
Yeah,
and
don't miss that Georgia fair, folks. If you're anywhere near Atlanta, Georgia, don't miss that fair. It's a well-run, wonderful experience. So all of these chapter events are really well put together, and I will say with a modicum of modesty that Mark and I do a pretty nifty program ourselves. So come on out and see us one of these times as we travel around the country.
Ken, do you have a date for the March roundtable handy so we could tell the audience?
The date for the March roundtable will be the 31st, last day of March, Mark.
Okay.
Right in the middle of baseball's first week.
And watch carefully. Natalie will be putting out an investing with Kim and Mark. We're going to be doing something during April with the balloon title or the overarching title of Money Smart Week attached to it. But I think we're going to talk about a little bit about how to be an investor, why you are an investor, maybe give you some real good ideas about supporting reasons for investing, and then trying to be very practical in how you go about starting the whole process.
All right. So with that, I think we can probably go ahead and shut down and take some.
I'm looking at our question box. Mark, John Poulet